Most people think owning some gold or silver automatically means they're protected, that just having exposure puts them on the safe side of what's coming. But history shows that's not how monetary transitions work. Because in every major financial shift, the people who thought they were prepared were often the ones who were underprepared. Not because they owned the wrong assets, but because they owned too little, owned them incorrectly, or misunderstood what those assets were actually supposed to do when the system came under real stress. As we move toward 2026, that distinction is becoming critical because the environment we're entering is not a normal economic slowdown. It is a structural transition involving debt, currencies, liquidity, and trust. And in that kind of environment, vague exposure is not the same thing as real protection. The reason this conversation matters now, not in hindsight, is because positioning for safety is something that must be done before stress becomes obvious, not after. And by the time the majority of people feel unsafe, the opportunity to position properly is already gone. This is why the question is not whether gold and silver matter in 2026, but how much is actually enough to make a difference. Because there is a massive gap between owning metals, symbolically, and owning them functionally. And that gap is where most people get caught off guard. Here's what most financial advisors won't tell you. The standard advice of holding 5 or 10% in precious metals was designed for stable economic environments. It wasn't built for what we're facing now. That percentage might have made sense when governments could still service their debts without printing money, when central banks had room to maneuver, when currencies weren't being actively debased to manage impossible debt loads. But we're past that point. The rules that worked in the past 2 decades are breaking down in real time, and the playbook needs to be rewritten. The question isn't just about allocation anymore. It's about survival of purchasing power in a system that's fundamentally changing how it operates. To understand what enough actually means, you first need to be brutally honest about what gold and silver are protecting you from. They're not magic shields. They don't prevent market crashes. They don't eliminate risk. What they do, very specifically, is protect purchasing power when the monetary system comes under stress, when governments choose inflation over default, when central banks choose currency debasement over economic pain, when the political pressure to keep the system functioning overrides the commitment to keep the currency stable. That's when gold and silver do their job. But here's the catch. Insurance only works if it's sized correctly relative to the risk you're insuring against. You wouldn't buy fire insurance that only covers 10% of your house value. So why would you protect only 10% of your wealth against monetary risk when the entire system is showing signs of structural instability? The risk profile heading into 2026 is different from anything most living investors have experienced. This isn't a normal recession where unemployment rises and GDP contracts for a few quarters before recovering. The core issues is debt saturation combined with political constraints on how that debt can be resolved. Global debt stands at roughly 335% of global GDP. That's over $300 trillion in total obligations against $90 trillion in annual economic output. The United States alone carries $36 trillion in federal debt, with unfunded liabilities for Social Security and Medicare adding another $100 trillion or more depending on how you calculate it. These aren't numbers that can be repaid through growth. The math doesn't work. And when the math doesn't work, something else has to give. History shows there are only 3 ways out of unpayable debt. Hyperinflation, where the currency is destroyed to pay off obligations in worthless paper. Jubilee, where debts are simply canceled by government decree. Or war, where physical destruction makes the debts irrelevant. Every major debt crisis in recorded history is resolved through one of these 3 methods. There is no 4th option. And right now, the most politically palatable path for Western governments is the first one. Controlled inflation that erodes the real value of debts while maintaining the illusion that obligations are being honored. This is what the Federal Reserve has been engineering since 2008. And it is what every major central bank is quietly coordinating as we speak. What makes 2026 different is that we're running out of time before the pressure becomes uncontrollable. Government refinancing needs are accelerating. The United States needs to roll over trillions in maturing debt each year while simultaneously funding massive deficits. Interest costs are already approaching $1 trillion annually, more than the defense budget. And that's at historically low rates. If rates rise to historical averages, interest payments could consume the majority of tax revenue. At that point, the government faces a binary choice. Default, which would collapse the financial system, or print, which would collapse the currency. They will choose to print. They always do. And when they do, the people holding cash, bonds, and fixed income instruments will be the ones who pay the price. This is where most people make their first critical mistake. They hear about monetary risk and inflation, so they buy a few gold coins or a couple of silver bars, and they think they're covered. They've checked the box. They own precious metals. But symbolic ownership and functional protection are not the same thing. If you own $50,000 in savings and you put $2,500 into gold, that's 5%. The historical data is clear on this point. During the 1970s inflation cycle in the United States, gold rose from $35 an ounce in 1971 to over $800 by 1980. That's a 23-fold increase. Silver went from roughly $1.50 to nearly $50, a 33-fold rise. People who held meaningful positions in metals during that period didn't just preserve wealth, they multiplied it. But people who held token amounts saw those gains evaporate into the broader losses from inflation, stock market stagnation, and bond collapses. The lesson isn't that metals are magic. The lesson is that sizing matters a lot. So what does meaningful actually look like in practical terms? Well, for most individuals, meaningful starts at around 10 to 15% of total net worth in precious metals. Not 5, not 3, at least 10, and in some cases, significantly more depending on your personal risk profile, debt levels, income stability, and geographic exposure. Below that threshold, metals act as a psychological hedge. They make you feel better, but they don't move the needle financially. Above that threshold, especially in the 15 to 25% range, metals start to provide real protection. They can offset currency debasement, they can cushion against financial repression, they can preserve purchasing power even if other assets stagnate or decline in real terms. But here's where it gets more complex. Not all precious metals exposure is created equal. The balance between gold and silver matters just as much as the total allocation. Gold is the anchor. It's less volatile, more universally recognized as money, and more liquid in global markets. Central banks hold gold, not silver. Sovereign wealth funds hold gold. When trust in currencies breaks down, gold is what people and institutions turn to first. Silver is different. It's more volatile, more speculative, and more tied to industrial demand. But that dual nature, being both a monetary metal and an industrial commodity, gives silver explosive upside potential during periods of monetary stress combined with supply constraints. The trade-off is that silver also experiences sharper drawdowns and more violent price swings. A conservative approach for most people is to structure their metals allocation with roughly 2/3 in gold and 1/3 in silver. This balance has historically provided stability from gold while capturing upside from silver without taking on excessive volatility. If you're more aggressive, you might shift closer to a 50-50 split, but that comes with the understanding that your drawdowns will be larger and your patience will be tested more severely. The key is aligning your allocation with your temperament, because the best strategy in the world is useless if you abandon it under pressure. And pressure is coming. Markets don't move in straight lines. There will be periods where metals appear to do nothing while stocks and crypto are surging. That's when most people sell, and that's exactly when they shouldn't. There's also the question of form. Physical metals versus paper instruments. This distinction becomes critical as systemic stress increases. Physical gold and silver eliminate counterparty risk. You own the metal. No one can default on it. No one can rehypothecate it. No one can freeze your account or deny your claim. But physical metals come with their own challenges. Storage, insurance, liquidity in smaller increments. Paper instruments, exchange-traded funds, mining stocks, futures contracts offer convenience and liquidity, but they rely on the stability of the financial system. If the system comes under real stress, those paper claims may not perform the way you expect. History is full of examples where paper promises failed while physical assets held their value. A layered approach makes sense for most people. Hold a core position in physical metals, enough to cover a significant portion of your net worth, stored securely, accessible if needed. Then use paper instruments for additional exposure, trading flexibility, or income generation through covered option strategies. But never confuse the two. Your physical position is insurance. Your paper position is a trade. They serve different functions. Mixing them up is how people get hurt. Now let's talk about the 2026 timeline specifically, because this is an abstract theory. We're talking about events that are likely to unfold within the next 12 to 18 months. The pressures building today are cumulative, not cyclical. Debt levels aren't expected to decline. Demographic trends are increasing entitlement costs. Political incentives favor short-term stability over long-term discipline. Central banks are trapped between controlling inflation and preventing financial market collapses. And every time they're forced to choose, they choose to support markets, which means more money printing, more currency debasement, more erosion of purchasing power. The sequence of events matters. Inflation doesn't arrive all at once. It comes in waves. Policy responses lag. Markets swing between complacency and panic. Gold tends to lead during confidence shocks. When trust in central banks or governments declines, gold moves first. Silver tends to accelerate later when liquidity expands and inflation becomes visible in consumer prices. Understanding this sequence helps you avoid emotional decision-making. If you're positioned correctly before the move starts, you don't need to chase performance. You just hold and rebalance when appropriate. One of the most underappreciated risks heading into 2026 is the erosion of real returns. Even if nominal asset prices rise, inflation-adjusted outcomes may disappoint. This is especially dangerous for savers who rely on traditional fixed income instruments, bonds, certificates of deposit, money market funds. These instruments promise nominal safety, but they offer no protection against purchasing power loss. If you're earning 4% in a money market fund, but real inflation is running at 10 or 15%, you're losing 6 to 11% per year in purchasing power. That's not safety. That's slow motion wealth destruction. Gold and silver don't produce yield, but they don't need to. Their job is to maintain purchasing power when yields are artificially suppressed and currencies are being debased. In a world where real yields remain negative, the opportunity cost of holding metals decreases dramatically. Another scenario to consider is volatility clustering. Long periods of calm often precede sharp bursts of instability. Markets tend to underestimate how quickly conditions can change. This is why waiting for confirmation is dangerous. By the time the need for protection becomes obvious to everyone, the price of that protection has already increased. Gold doesn't spike after the crisis is over. It spikes when the crisis becomes undeniable. If you're buying at that point, you've already missed a significant portion of the move. Preparing gradually, while conditions are still relatively calm, reduces both financial and emotional stress. There's also a geopolitical dimension that can't be ignored. The fragmentation of global trade, the emergence of alternative currency blocks, the weaponization of payment systems through sanctions, all of this increases the value of neutral reserve assets. Central banks have already responded by increasing gold holdings, not because they expect immediate collapse, but because they're reducing dependence on assets that carry political risk. The same logic applies to individuals on a smaller scale. Diversifying away from any single system, any single currency, any single jurisdiction reduces vulnerability. Gold and silver are the ultimate diversifiers because they exist outside the political system entirely. Here's a mistake people make constantly. They treat metals as a trade rather than a position. Trading requires timing, discipline, constant monitoring, emotional resilience under pressure. Positioning requires patience and clarity. People who constantly adjust their metals exposure based on short-term price movements usually end up with worse outcomes than those who establish a thoughtful allocation and simply rebalance occasionally. The goal isn't to outsmart the market. The goal is to remain solvent and flexible across a wide range of possible outcomes. That's a very different objective, and it requires a very different mindset. Rebalancing itself is critical, but often neglected. As metals perform well relative to other assets, their share of your portfolio increases. At some point, trimming that position and reallocating to undervalued assets makes sense. It locks in gains, reduces concentration risk, and maintains balance. Conversely, during periods when metals underperform, adding modestly can restore your target allocation. This systematic approach removes emotion from the process and aligns your behavior with long-term objectives rather than short-term noise. For those worried they're starting too late, understand this. Preparation isn't binary. Being partially prepared is infinitely better than being completely unprepared. The worst position is paralysis. Doing nothing because you can't do everything. Markets don't require perfection. They require prudence. Spreading your adjustments over time reduces timing risk and psychological burden. Dollar cost averaging into metals over 6 or 12 months smooths out volatility and prevents the regret of buying everything at a local peak. It's not sexy, but it works. Let's address the social aspect of this conversation, because it matters. Discussions about gold and silver often attract extreme viewpoints. On one end, you have dismissiveness, people who think metals are relics, that they have no place in modern portfolios, that anyone holding them is paranoid or out of touch. On the other end, you have obsession. People who think metals are the only assets worth holding, that everything else is a scam, that collapse is imminent and inevitable. Neither extreme is helpful. Metals are tools. They're part of a broader strategy, not a replacement for it. Keeping that perspective prevents emotional overinvestment and reduces the risk of disappointment when metals go through inevitable periods of underperformance. As we move closer to 2026, the question isn't whether the financial system will function. It will. The question is how it will function and who it will favor. Systems under stress tend to favor debtors, large institutions, and those closest to the levers of policy. Savers and wage earners tend to bear the cost. That's not a political statement. It's an observation based on history. Every time governments face the choice between protecting creditors and protecting the currency, they choose to protect the system, which means inflating away debts and transferring wealth from savers to debtors. Gold and silver provide a way to opt out of that dynamic, but only if held in sufficient quantity to matter. Ultimately, enough is the amount that allows you to sleep at night while remaining financially flexible. It's the amount that would meaningfully offset a decline in purchasing power without forcing you to sacrifice liquidity or opportunity. It's not a number someone else can give you. It's a range you arrive at through honest assessment of your own risk tolerance, financial goals, income stability, and personal temperament. But if you're holding less than 10% of your net worth in metals, and you're concerned about monetary instability, inflation, or currency debasement, you're probably underallocated. And if you're holding more than 30%, you might be overexposed to volatility and liquidity constraints unless you have very specific reasons for that level of concentration. The most important takeaway is this: preparation is not about predicting disaster. It's about acknowledging uncertainty. Gold and silver are not bets on collapse. They're acknowledgments of limits. Limits to how much debt can be accumulated. Limits to how much currency can be printed without consequences. Limits to how much trust can be eroded before confidence breaks. As those limits become more visible, the role of tangible monetary assets becomes clearer. If you've been focused exclusively on short-term price movements or headlines, this broader perspective is essential. The real question isn't what metals will do next week or next month. The question is whether your financial structure is resilient enough to handle multiple scenarios without forcing you into reactive, emotional decisions under stress. That's what enough really means. It's the level of preparation that allows you to navigate uncertainty without panic. As we move toward 2026, the people who will do best aren't the ones who guess perfectly. They're the ones who position thoughtfully, size appropriately, stay disciplined, and avoid the extremes of complacency and panic. Gold and silver are tools for that discipline. They're not shortcuts. They're not get-rich-quick schemes. They're insurance policies that only pay off when the things most people take for granted start to break down. Used wisely, they provide stability in an unstable world. Used carelessly, they become just another source of stress and regret. The window to think clearly is always before urgency takes over. Right now, that window is still open. Conditions are relatively calm. Markets are functioning. Prices haven't spiked into panic territory yet, but windows don't stay open forever. And the cost of waiting until everyone else realizes the same thing you do is always higher than the cost of acting early. The goal here isn't to be alarmist, it's to be realistic. The system isn't collapsing tomorrow, but it is changing. And the people who recognize that change early, who position accordingly, who understand the difference between symbolic exposure and functional protection, those are the people who will preserve their wealth while others watch theirs erode. So ask yourself honestly, if inflation runs higher for longer than expected, if currency debasement accelerates, if trust in central banks and governments continues to decline, would your current allocation to gold and silver actually make a difference? Or would it just be a footnote in a broader story of purchasing power loss? Because that's the real test, not whether you own some metals, but whether you own enough to matter. And if the answer is no, the time to fix that is now, not when everyone else figures it out too.